online. If I can get it to work. This is the first time I've actually used this technology. So we've been considering doing this sort of presentation for a long time. For those of you who don't know me, I'm Roger Royse. I'm the founder of the Royse Law Firm. We're business lawyers. We're not. We don't do what you do. But I've been considering doing a presentation on that intersection of family law and tax law, tax and business law, especially as it relates to issues that come up in the business world, and in particular some of the tax issues, especially in this valley where we have a lot of equity compensation. So in putting this panel together, what we decided to do was to have a short presentation by our three panelists, myself, as well as Jason Crowley, who will go next, and then Hal Friedman, who's a CPA. And we're basically going to hit some of the big tax issues that arise in divorce. And in particular, we want to address some of the issues surrounding transfers of business interests, stock options, things like that. So, and then we'll leave time. We have a short presentation, and we'll leave time for questions. So let's see if I can get this to go full screen. So just briefly, I can't get that thing to move though, can I? I should have figured. Does anybody know how to do this better than me? Oh, wait a minute. Well, all right. I have a handout, by the way. It's right in the middle of the table that I'm just going to go through. You can follow along with. And by the way, we have 3 handouts here. I've only got 1 printed out. Looks like 2 printed out. If you want to leave me a card, I'll email you the other 2 handouts. So just as an overview, I want to hit some of the issues that we see come up most often. Tax issues inherent in transferring assets, the tax liabilities that should be considered when an asset is transferred, some business tax concepts, net operating loss, capital loss, passive activity loss, and special issues relating to S corporations as well as limited liability companies and tax treatment of attorney's fees. Boy, oh boy. So first, I think we're all familiar with Code Section 1041, which primarily deals with transfers between spouses. And it provides generally that whenever a spouse makes a transfer to another spouse, that's a gift. Okay, it's a non-taxable transaction. It's not elective. That's just the way the law is. And 1041 goes on to provide that spouses between incident to a divorce is also treated as a gift. And what that means, as you probably know, is that it either occurs within 1 year of the cessation of a marriage or related to the cessation of a marriage, which means pursuant to a separation or divorce instrument and within 6 years of the cessation. Then there's a presumption that it's related to cessation. Now, as a tax matter, why that's all important to us is because if it's a transfer pursuant to 1041, there's no gain or loss, but that means that basis just carries over. And all other attributes in that asset carry over, with some exceptions I'm going to talk about in a minute here, carry over to the transferee spouse. And this is true whether you intend that to be true or not. And as a planning matter, it's sort of important to understand what the tax attributes are that are inherent in an asset. And for example, well, basis is the important one. There's also tacking. There's also tax history. And where this becomes really significant is when you have one spouse selling an asset to another spouse. And if that sale is incident to a divorce, you don't have a sale, right? If it's under 1041, what you have is a gift and then a transfer of cash. So just think about it. And where this would come up is oftentimes you'll see the idea of one spouse having a right of first refusal, for example, on a residence. So in other words, you get to live in it for a while, but then if you ever sell it, you have to give me the right of first refusal, the other spouse, so I can buy it because I kind of like the house too. Well, that may or may not work. You may end up thinking that the purchasing spouse that he's spending $1 million and buying an asset and getting $1 million basis, but if he ends up under 1041, which is not elective, he just ends up under it. Instead, what he's done is he's gotten a house with a very low basis and he's made a transfer, a non-taxable transfer of $1 million in cash. So it's important to, I guess, to understand there's not a lot of, there is some planning you can do, but the planning is factual. It's not so much planning in terms of drafting. More of the planning is just understanding where the taxes incident lies and what to do with it. There are some exceptions to 1041 that are worth noting. The important one around here, anyway, for us, is a transfer to a non-resident alien. That doesn't qualify for 1041, and you can sort of understand why. It's because the IRS, that's the last chance that the IRS is going to have to collect tax on an appreciated asset, then it leaves the U.S. taxing jurisdiction. And then, of course, the big one, if it's not incident to the divorce, meaning that it occurs more than a year after the date the marriage ceases and is not related to the cessation of the marriage. That is sometimes a factual issue. Moving right along, principal residence exclusion, just as, let's get us all on the same page, just so we're all up to date. Remember, that's the exclusion of gain from the sale of a principal residence. $500,000 jointly, $250,000 with respect to married filing separately. This also applies, so the significant thing here is that either there's a requirement that the property be used as a principal residence for 2 of the past 5 years. And this requirement is met if either spouse has met the use requirement. And neither spouse has made a similar 121 sale within the previous 2 years. If this is true, then a spouse can inherit the transferor's ownership history. So, for example, if one spouse has lived in their residence for 2 of the past 5 years, the other spouse is awarded the residence or awarded use of the residence after the divorce, they inherit that history. Now, there's an interesting issue that comes up in this. You're all familiar with this. You've been through it a million times, right? There's an interesting issue that I only discovered through preparing for this presentation, actually, that comes up because there's a split of authority among commentators, law on this that I've seen, as to whether this is a $250,000 exemption, a $500,000 exemption, or a $750,000 or $1 million exemption. And the scenario is where husband and wife live in a residence, they meet the 2-year requirement in 5 years, and then they split up, and one spouse stays in the residence, and then she remarries, okay, and then they sell the residence, all right, and the court, and let's say the court has awarded one spouse the spouse use of the residence, but both of their names are untitled, so they split the proceeds on sale. Okay, that's the scenario. Okay, you got it? Say that again, right? So now they sell the residence. Well, who gets that exemption? You would think that it would be $250 to each, right? But keep in mind, you've got 2 married people that have lived in a residence now, and the statute says they get a $500,000 exemption. Okay, so $500,000, that's ex-wife plus husband, new husband, right? Because she remarried. So now they take $500,000. Well, does that leave anything left over for the other spouse, the one who's not in a residence? There's an issue there, right? Well, there is authority. There's no authority. There's commentators who take all different positions on this. And it gets even more complicated. Suppose the spouse who's not in a residence but is entitled to half the proceeds. Suppose he remarries. Well, does he get a $250,000 exemption or a $500,000 exemption? It's one of those things that's probably best dealt with, by agreement and just understanding how this might play out, what might happen, because this is where 121 gets to be really interesting for a tax lawyer. Allocation of inherent tax liabilities. I think we talked about that. It's just a carryover basis. We should just understand that there is inherent tax cost whenever an asset is transferred, because if there's appreciation in it, and that's something that needs to be factored into the equation. There's some interesting law in California on whether a court will consider the inherent tax cost in an asset when it values an asset. And in my materials that I can email to you, I'll give you the citations. But there's a case where somebody was a partner in a law firm, and he had the right, of course, to withdraw, his interest in the firm at any time. But if he ever did that, he was subject to tax. And there's a question as to whether the value of his partnership interest should be adjusted downward because of that tax liability. And the court said no, because you haven't shown us that that's going to happen, that that's imminent. You might be in that law firm for a very long time. The value might go down, it might go up. So the rule in California, of course, is that California courts will adjust the value of an asset for tax if one party is going to suffer immediate tax consequences. All right, with that background, I want to hit a couple of major issues. Net operating losses. We understand what a net operating loss is. Parties operate a business, they generate a loss in excess of income. They can typically carry it back 2 years and forward 20 years. At divorce, net operating losses, you should consider that to be an asset in the divorce. But you don't get the right. You're not able to simply allocate it however you want to. It gets allocated to parties based on their share. In other words, how much their business has contributed to that NOL. I did find, again, in preparing for this, I did find some contrary authority in a different state that I don't think is very persuasive. Capital loss, carryovers, same rule, it gets allocated among the spouses. Now, capital losses are different in that they're only deductible against capital gains plus $3,000 a year, and they're carried forward indefinitely. But again, it's an asset that can be allocated in the divorce. But again, it gets split depending on how much each spouse has contributed to the capital loss that generated the carry. Now, here's the interesting one, passive activity losses. Because this is a little bit something that you might not have run across, it's a little bit counterintuitive. But the concept behind it, when you're evaluating, how much loss and how much that loss is available and how valuable it is to parties, consider that the tax code limits losses for passive activities, limits the deductibility against income for passive activities. All right, so the rule is you can't go out and find a passive activity, invest in it, generate a loss to offset your compensation income, for example. So people, pretty much everybody that invests is running around with lots of passive activity losses, and they just sit there and they wait until somebody actually exits the activity. Sell the stock, they dispose of the business, and then at that point they get the loss. Those assets are divided in kind as a tax asset in divorce as well. And they're divided, and they basically follow the asset, all right? They follow the activity. And the way the code does this, however, is it increases the tax basis of the asset. So suppose one spouse owns stock in an S corporation and has been unable to deduct losses from the S Corp from all these years because of this limitation, because it's a passive activity. They transfer the stock to another spouse. The loss itself doesn't go, but the basis of the stock in the S Corp is increased so that the transferee spouse has a larger basis. So when they sell the stock, they're going to have less gain. That's how the code deals with that. Interestingly, that's how they deal with S corporation suspended losses as well. In an S corporation context, a shareholder of an S corporation is only allowed to deduct losses that pass through them from the S corp to the extent they have basis. To the extent losses exceed that basis, they're just suspended until they get basis. And the way the code deals with it is when a spouse transfers property at divorce, rather than transferring the suspended loss, which would normally go away, just increases the basis in the S corp, so the transferee spouse will eventually get the benefit of that. Now, one thing I want to pause on is the allocation, because this is an issue that comes up for me in my practice in all different scenarios, not just divorce, but whenever parties are dealing with business interests, because the rules can really get you, right? S corporations and LLCs are pass-throughs, which means that the owners of the entities, they pay tax on the income of the entities, whether they get it or not, right? It's a pass-through. So that's the first thing to remember, is that if you have a transfer of an interest, somebody exits an S corp because husband transfers his S corp stock to wife halfway through the year, he's not done. He's going to get a K-1. Hal here is going to send him a K-1 in April of the next year, and it's going to show some portion of income or loss on it. I think the important thing here is same thing with an LLC, limited liability. The important thing is to recognize that, to understand that there's a tax liability or tax benefit associated with the asset, and to factor that into the valuation. I go one step further, and I would say that you want to draft into your documents exactly the methodology that the parties are going to use when they allocate the income from the S Corp or the LLC. Because if you don't draft it into the agreements, the code is going to supply it. So in other words, the code tells you how you allocate income in an S Corp and an LLC unless you agree otherwise. And with an S Corp, it can be pretty ugly because a person who a shareholder of an S Corp on January 1 or say March 1 can be allocated income that doesn't even arise until December 1, even though they've exited back on March 1. Because the S Corp will allocate, unless you elect otherwise, income based on a per share per day rule. Right, to take income from the whole year and then take 1/365th for each day. So it's important to pay attention to that. And then the last thing on business entities I want to touch on briefly has to do with redemptions. And those of you who have been doing this for a long time may remember that there was a long line of cases going every which way on what happens in the redemption case. And here's the scenario. In part of the divorce is that, gee, you can have my stock, wife, but you got to give me some cash. Okay, but let's do it this way, or otherwise. I'm going to give you cash, but I'm going to get it from my company. So rather than going in this triangle, what we would do is have the company redeem stock. Rather than sell stock, we would just have a company redeem it. Right? So they give me cash, I give you stock. Now wife owns everything. Right? We're 50-50. Redeem me out. And that way we use the company money. So there used to be a question as well, gee, who should get taxed on the distribution from the company out to the shareholder? Did the money go out to the 50% husband shareholder and then go from the husband to wife? So husband is taxed on that distribution. Or instead, did it go from, because it was his obligation to pay the wife, or instead did it go from company directly to wife, in which case she should be taxed on the transaction. Right? Because if it goes to husband, then the wife, 1041 protects wife. She doesn't have any tax on it. And the cases were all over the place. But we now have a statute that basically will treat the redemption as a constructive distribution in a written agreement. So in other words, the moral of the story is you have to agree. Your agreement, your settlement agreement just has to say when that money comes out, who it belongs to. Otherwise, it's going to be treated as going out to the husband and then over to the wife because it's satisfying his obligation. Briefly, because I'm using up too much time, legal fees. People are always asking me what to do about taxation of legal fees. You may know generally divorce-related legal fees not deductible, alimony-related legal fees deductible if somebody is going to court to enforce alimony because that's an expense incurred in connection with collecting income, taxable income, but legal expenses to collect something that is not income, non-recognizable, would not be deductible. It sort of makes sense, right? You should get a deduction for the cost of collecting income. You shouldn't if you're getting for the cost of collecting something that's not income. The big one, of course, are tax-related legal fees, generally deductible. The question is usually one of specifying how much of your legal fees actually went into tax advice and how much is for unrelated matters. The interesting issue here for me has to do with attorney's fees treated as alimony, and those are the scenarios that come up because, as Hal's going to talk about later, to be alimony, if it's alimony, it's a deduction to the payor, it's income to the payee, as opposed to non-deductible payment of the other party's attorney's fees. So that's usually the tension. And fees can be alimony. They can be, provided they meet all the other requirements that Hal's going to talk about. They're not front-loaded. It ends on death of the payee, etc. Okay, now with that, what I'm going to do is turn the presentation over to Jason, who's going to get more into some of the business issues, retirement plans, and stock options, if I can figure out how to do this. All right. Jason, you want me to flip these for you, or do you want to do it? Okay.
Go to the bullpen. And did all of you see that? There's the handout. Okay, great. So what I'm going to be covering primarily is equity compensation, stock options, and retirement plans. I'll try and spend the majority of the time on equity compensation, being in the area that we live in. It tends to be very prevalent. So to start, just wanted to kind of go over some of the key terms and dates, get everyone on the same page. The grant date is the date that the option is granted to the employee. The exercise date is the date that the option is actually converted to stock, the date that the employee chooses to purchase that option. The exercise price is set on the grant date and is the actual price that the employee will pay to convert that option. The vesting date is the date when the restrictions are removed. Sometimes with a lot of the companies in this area, a lot of the private pre-IPO companies, they'll offer an early exercise plan. The vesting date, even if they exercise early, the vesting date will be the date that those restrictions are actually removed. And the bargain element refers to the difference between the strike price on the option or the exercise price and the actual price that the employee pays when they convert it to stock. There's generally 6 types of equity compensation. I'm going to spend the majority of time talking about non-qualified stock options and incentive stock options. Just to give you a quick run through, restricted stock and restricted stock units, or RSUs, are really very similar. The key difference is that RSUs are an unfunded, really just an unfunded promise by the company to issue stock at a later date. But the tax consequences on those are very similar. Aside from the fact that RSUs, you don't have the ability to make a Section 83B election. And I'll get into that a little bit, but trying to keep it fairly high level. On the non-qualified stock options and incentive stock options, those are the non-qualified basically means that they don't meet certain requirements in order to be qualified. So they're also known as non-statutory stock options. Incentive stock options adhere to these strict requirements in the code, and as a result, they get preferential tax treatment on those options. And we'll dive into those a little bit more. So as I said, non-qualified, there's no preferential tax treatment. What you'll see in kind of general taxation issues is that there's no tax on the grant date unless there's a readily ascertainable market value, which typically there's not. On non-qualified stock options, the employee doesn't report income until those options are exercised. Typically, if they're vested, the employee is going to report ordinary income equal to the spread between the purchase price and fair market value. If it's not vested, then they're going to report income when the shares vest. If they're not vested, there is a different tax treatment if the employee chooses to make the 83B election. What the 83B election does is it basically starts the clock, and the options are treated as if they'd been exercised. If the employee decides to, after exercise, to hold on to the stock for a period of time, they'll recognize a capital gain or loss when that stock is ultimately sold. Incentive stock options adhere to a number of different requirements. Also, there's no tax on the date of grant. The real key difference and the big advantage of incentive stock options is you have the ability to convert ordinary income to capital gains treatment. So under the non-qualified stock options, that bargain element is going to be taxed as ordinary income. If you meet the holding requirements that are laid out for incentive stock options, then you have the ability to convert that ordinary income to capital gains taxes and pay a much lower rate on that. And that's going to be taxed at capital gain at the date of sale for the difference between the sales price and the exercise price. So again, the difference between that exercise price and the actual price paid is you have the ability to kind of flip that over from ordinary income to capital gains. This is one of the key provisions of an incentive stock option, deals with these disqualifying disposition. And what a disqualifying disposition is if the employee sells or transfers the stock within 2 years of the date of grant or within 1 year of the date of exercise. If that happens and they transfer it before either of those 2 dates, then the incentive stock option loses its status as an incentive stock option, and essentially transforms into a non-qualified stock option, with the exception that it will be taxed in the year of disposition as opposed to the date of exercise on the non-qual. And that's going to come into play as we get into some of the division of stock options and looking at some of the tax implications of that and what some of the guidance is that the IRS has issued. The courts, as I'm sure you're all aware, have really wide discretion, great degree of discretion in their ability to allocate community property and separate property interests in stock options. They typically use one sort of the time rule method, whether it's Hug, Nelson, or a few different others. But like I said, they have a wide or a great degree of discretion in how they view that. These are a couple of the key revenue rulings that have come down related to non-qualified stock options. Before these revenue rulings, there really wasn't much guidance on how the employee and non-employee spouse, what the tax implications would be based on the division of options. So this, as revenue rulings, are really the authoritative guidance on how to divide and allocate stock options and what the income tax treatment will be on those options. So what these revenue rulings said in summary is that the transfer of non-qualified stock option to the non-employee spouse from the employee spouse is not a taxable event. The non-employee spouse will report income at exercise. Now, one thing to note is that the employee spouse is still responsible for FICA taxes, the Social Security and Medicare taxes. That's because those taxes are unique to the individual and they can't be transferred. These rulings also applied and said that the same treatment would apply to non-qualified deferred compensation plans as well. Also, another thing that's important to note is employers are not required to divide options, so it's really crucial to check before the fact with the plan administrator, make sure that they are going to divide it. If they do divide it, then they will issue a 1099 to the non-employee spouse. Moving on to the division of incentive stock options in divorce. The designation, these are these are private letter rulings, meaning that they can't be cited as authority because they relate to a particular set of facts. However, what they do provide is some guidance on the IRS viewpoint towards these transactions and transfers. In a private letter ruling 2005-19011, this all comes back to the disqualifying disposition that we talked about a little bit earlier. Designation of the non-employee spouse as beneficiary of the incentive stock options will not disqualify them. And the transfer of the stock to the non-employee spouse is not considered a disposition. Essentially what this means is that the non-employee spouse steps into the shoes of the employee spouse. They're not looking at this as a transfer. They're not looking at it as a disposition. So the employee would recognize, or the non-employee spouse, excuse me, would recognize alternative minimum tax resulting from exercise and would also recognize any income and income tax withholding would be allocated to them exactly as you would think that it should play out. Private letter ruling in 2007 reinforced that, again allocating to the non-employee spouse the income and tax withholding consequences on the share of their incentive stock options that remain in the name of the employee spouse. Private letter ruling 2010-16031 deals with restricted stock and again said that the division of restricted stock pursuant to divorce is a non-taxable event. Income reported upon vesting would be divided between the parties. So the IRS really came in and said basically what we would like them to say. They gave some guidance. The one regrettable factor on the incentive stock options is that it is a private letter ruling, so again, can't be cited. However, it does give some guidance. Moving on into retirement plans, there's really three broad umbrella types of retirement plans: qualified plans, non-qualified plans, and tax advantage plans. Some examples of qualified plans are 401ks, profit sharing plans, pension plans. Qualified, the easiest way to think about that is it qualifies for favorable tax treatment by meeting special provisions laid out in the Internal Revenue Code. Some examples of the non-qualified plans: deferred compensation plans, executive bonus plans, split dollar plans, group carve-out plans. These are designed primarily as top hat plans, so that they don't meet some of these provisions. They don't have to qualify for discrimination testing or top-heavy testing, so they enable the employer to provide a select group of executives and highly compensated employees with additional compensation and additional benefits. Typically, these plans are unfunded, and they're never protected by the Pension Benefit Guaranty Corporation. So it's important in that case, because it's not protected and it's unfunded, it's important to include provisions of what happens in the case of bankruptcy, with something that we didn't really think about too long ago, but important to take into account. Individual retirement plans, IRAs, are not a qualified plan. They're not subject to 20% withholding. They may be transferred. A QDRO is not necessary, and we'll get into a QDRO a little bit later. One thing to note here is that under Rule 72T, there's a planning opportunity if you do want to inject some liquidity. Let's say that the couple doesn't have a lot of liquid assets, needs some cash to make it through. Rule 72T allows you to take distribution before the age of 59 and a half. So it's essentially a way to avoid the early withdrawal penalty by taking distributions before age 59 and a half. The requirement in order for it to abide by the Rule 72T is that it makes at least 5 substantially equal periodic payments. So again, it's a way to tap into the funds in the IRA and avoid the 10% penalty. You will pay taxes on that income, however you avoid the penalty. QDRO, Qualified Domestic Relations Order. I know most of you are all very familiar with this. Some of the requirements and kind of the key points to touch on there are that what a QDRO does is it allows you to divide a retirement plan, qualified retirement plan, pursuant to divorce, and transfer to the non-employee or non-participant spouse a share of the benefits or interest in the qualified plans. It must relate to the payment of child support, spousal support, or marital property rights. It also must be approved by the plan administrator. Every employer has their own specific guidelines and requirements. So again, important to check with them before the fact to make sure that everything's spelled out according to plan. It cannot require the plan to provide increased benefits or alter the way benefits are paid. There's also another opportunity to take early distributions pursuant to a QDRO. So under a normal circumstance, a participant is subject to an early withdrawal penalty for taking distributions prior to age 59 and a half. They're taxed 10% at the federal level and 2.5% at the California level, at the state level. Pursuant to a QDRO, the penalty does not apply. So this is a one-time shot that essentially gives you the ability to take a distribution to the alternate payee and access these retirement assets without penalty. So again, you have the opportunity to inject some liquidity. An example of this would be, let's say that there's a retirement plan with $200,000 in it, and wife needs $80,000 to pay legal fees and just sustain themselves. They're going to divide this retirement plan in half. She could take a $100,000 distribution pursuant to the QDRO, avoid the 12.5% early withdrawal penalty. It would be subject to a 20% withholding. So if she wanted to take $80,000, she would want the distribution to be for $100,000. The company would withhold 20%, and she now has $80,000 and was able to avoid the 12.5% penalty. Lastly, kind of a miscellaneous issue, the Kiddie Tax. The way the Kiddie Tax works is it was really designed to encourage or discourage income shifting. So what parents were doing is they were taking investment assets, moving them over into the name of their children, and presumably these children were in lower tax rates. The investment income was then being taxed at the child's tax rate. This applies to kids by definition under age 19 or full-time students under the age of 24. So to discourage this, the IRS instituted the Kiddie Tax, and that applies to when a child has unearned income in excess of $1,900. The way this tax works is first the first $950 of income is not taxed. The next $950 of income is taxed at the child's tax rate, and anything in excess of $1,900 for 2012 is taxed at the parent's tax rate. Where this comes into play in a divorce setting is that it's the taxable income of the custodial parent that determines the child's tax liability. The custodial parent is also the one who's responsible for filing the child's tax return. They have two options to do that. They can either include the child's unearned income, investment income on their tax return, or they can have the child file their own tax return. Kind of the overriding themes, the key takeaway is that, don't remember exactly what case this is from, but state law may indeed determine the right and ownership of property. However, the Internal Revenue Code determines how those property rights are taxed. So what this means is that you can write anything you want, structure an agreement any way you want, and the IRS will respect that as it relates to community property and state law. But if you were including of how the IRS should treat that tax, the IRS is going to come in and say, well, that's not the way we look at it, and theirs is going to be the overriding thing. Pass it over to Hal.
So everyone should have an outline and a very low-tech system. Anyway, as far as filing tax returns go, everybody knows that each spouse would have to file an annual tax return, and the preliminary consideration is, are you filing a joint tax return with your spouse, or are you filing a separate tax return? If you file separately, there's three possibilities. You could be a head of household, which means you have a qualifying dependent. You could be married filing separately, which means you are still legally married, but filing a separate tax return from your spouse. Or you could be single, which means you're unmarried. And it is your marital status on the last day of the year. And there have been court cases where people get divorced on December 30th and remarried on January 2nd, and the court, if they're found out, the court does look through that and say that's a shame. So anyway, joint return usually carries the lowest tax liability unless the spouses really have equal income. And a lot of times they're not legally divorced yet, but their assets are really separated, and so they're still required to file a joint return, but they don't cooperate with each other. The joint return usually being the lowest tax liability, it's a preference, so we try to make it happen if possible. We can allocate, or the accountant can allocate income on a joint return. So if the spouses really have their financial assets separated, but they haven't gone through the process where they're qualified to be legally divorced, we can do a calculation that shows, spouse A has this much of the income on the joint return, spouse B has this much of the income on the joint return, and we can take into account spousal support in that calculation, calculate the percentage of the joint income that each spouse has, and allocate the tax liability that way. If they are legally divorced by the end of the year or qualify to file singly, and usually if there is a minor child, one spouse may be able to qualify as head of household. And then the combination of filing a head of household with a single, the other spouse being single, can often result in a lower tax liability also. So again, it's the marital status on the last day of the year that qualifies you to determine the filing status. Where we saw a lot of situations where innocent spouse came into play, was back in the 90s, where there was a lot of stock option exercises back when NASDAQ was at 5,000, and a lot of your high-tech stocks were in triple digits, and then shortly went down to single digits. And so there was incentive stock option exercises that created huge alternative minimum tax liabilities, and then the stock plunges, it creates stress, the spouses get divorced. The stock doesn't cover the back tax liability. What happens? One spouse says, your decision to hold it. I had nothing to do with it. You made the decision. You never told me we would owe tax. We haven't seen as much of that lately, but it would still be out there. And sometimes these cases do drag on for years if the people haven't paid the back tax liability. So if worse comes to worse, then you can try for an innocent spouse if you have a big unpaid tax liability situation. At times it's been very difficult to prove, and then theoretically the IRS did lighten up a little bit on the administration of how difficult it is to prove an innocent spouse or not. So there's a form and a process, and it can be slow going procedurally as well, to get something through that. A lot of these things are not audited, so that they're basically self-reported. If you file a tax return electronically, you have to prove head of household status to California automatically. You don't accept an electronic filed return for head of household unless you fill out your head of household questionnaire as part of it. Federal will only do it on audit. California generally does audit whether you file paper or electronically, head of household filing status. On alimony, everybody knows alimony deductible to the one spouse, taxable to the recipient spouse. Child support not deductible to the paying spouse and not taxable to the recipient spouse. So a lot of times, if one spouse is not working, if all they're receiving is child support, they would have no income, no tax, where the spouse paying the child support would have no deduction, a lot of income. And so that may not work out from a tax point of view. So from a tax point of view, a lot of times the attorneys will try to more or less equalize the income to some extent, so that because there are some graduated rate brackets, still not as many as there used to be, and not as many as we may have going forward. There is some benefit to have each spouse have taxable income. Either from job income, investment income, or from this family support, spousal support. We don't like, in the tax return profession, we don't like to see vague family support in an agreement. We want it very crystal clear, this much is alimony, this much is child support, and it ends so-and-so. We also like to see who's claiming which child as dependent. And there's a form I've attached to the packet for a non-custodial spouse to be able to claim a dependency deduction for a child who you do not have physical custody of. And again, we'd like to see, spouse A claims Billy this year, spouse A claims Janie next year. Spouse B claims Billy next year, spouse B claims Janie this year. Just so that everything's crystal clear and there's no issue as to if you file electronically and you both claim the same child as a dependent, only one return will go through, whichever one files first. The second one will get bounced because of the Social Security number. It will show up as having been claimed on a tax return already. To avoid that, file paper. You may be able to both get by. You may be able to both claim head of household. There may be a lot of inconsistencies that are stopped electronically that do squeak by on paper still until somebody audits you. It's the alimony and child support. So family support we still see in some agreements. I have a little blurb on that at the back here, but again, really strongly prefer to have the agreement specify, is this child support, is this alimony? Follow up on a couple other things that Roger and Jerry alluded to. The house sale scenario is one that can be very scary, and we've seen that situations where there's young children, and the agreement provides for the one spouse to stay in the house till the children go off to college, and then the house to be sold and proceeds split. There is, in my mind, still an issue as to for the spouse that's not residing in the house. Does that spouse qualify for the principal exclusion at all, let alone the remarriage issues for the 250 or the 500 or possibly more. There are court cases, though, which hold that two people that jointly own a house, two couples, and sell that house, even if they're both living there, you cannot get $1 million of principal exclusion. It's kind of a per house basis of 500 days. So there's some evolving areas of law there as well. Again, in the tax return profession, we love to see everything specified on the carryforwards, which Roger mentioned. They really want to see, okay, capital loss carryforward will be split among the spouses in this ratio. The passive loss carryforwards will be split, and then operating loss carryforwards will be split. The investment interest expense carryforwards will be split. The alternative minimum tax credit carryforwards will be split. The business investment tax credit carryforward, etc. It's really a good idea to work with the accountant if you need to go through the prior tax returns, see what all the possible carryforwards are, so that you can allocate those, so that there's no issue, there's nothing to fight over, or have inconsistencies. One of the things that Jerry was talking about on the exercising of stock options by the non-employee spouse. We've seen a couple situations where the employee spouse has limits where they can exercise or cannot exercise, and they're blocked out most of the time. They cannot exercise because they're on the board, they're insiders, they have a 5 plan or something. And then the non-employee spouse wants to exercise, and then they have to have a mechanism to go through the employee so that the employee can exercise. And again, if that's the situation, I'll just encourage you to plan ahead. On the Kiddie Tax thing, basically it's into a philosophical discussion on the income tax going forward, is if you repeal estate tax, repeal gift tax, and you allow unlimited gifting because you've repealed estate tax, and have you really destroyed your income tax base? Because now everybody's going to give to their non-working grandparents and non-working children and non-working brothers, sisters, etc. And do you really eliminate income tax base? And that's part of the reason for the Kiddie Tax. Dependents, generally, like I said, one spouse can claim one child, and there are rules, and they generally are fairly straightforward until you get into the more complicated situations, of course, where it's exactly 50-50 custody and 50-50 support, or support's coming from elsewhere. And a lot of the benefits of a lot of these things are phased out as the incomes get high, so for a lot of our clients, it ends up not being a practical issue. But for clients where there are lower income, where there are tax benefits for claiming children, claiming child tax credit, child care credit, things like that, the deduction for exemption, of course, it's important, again, in my mind, to have everything specified as to who claims which spouse, who claims which child. So anyway, that's a summary. I have attached here a lot of pages from where I think your starting point is if you have the basic questions. Or it's IRS Publication 1, and it goes through the rules for filing status, the general rules, and it also goes through the rules for who can claim somebody as a dependent. And so that's the starting point, I think, that would answer most of your questions. Thank you.
Okay, thanks, Al. So why don't we open it up to questions with the time we've got left.
Hi, these questions are for you, Eric. Just a few questions. First of all, in regards to the capital losses that you mentioned, they allocated based on the particular spouse. So hypothetical, if husband was doing all kinds of activities during marriage, they were on wife claim breach of fiduciary duties, and she didn't prevail, but there was a lot of capital losses that parties carried forward, and they needed to figure that out. Would they allocate that based on husband's activities or wife's, or would the court normally divide that at time?
I think he allocated on the way they would allocate it if they were to file separate returns.
Okay.
So for his husband's activities, he would have taken the capital loss on his separate returns, so he should be entitled to it.
So if wife had no income at all during that time period, and this was all husband's doing it?
Well, if you're, we're in California, I assume.
Community property state.
So you're community property states, so they're both, it's probably community property, community income, community loss, so they probably both get half. Al, do you agree with that?
Yeah, I think, again, in my mind, there's nothing that's specifically legally required if the spouses can agree on how to divide up the carry forward. So generally, we look first for an agreement. Then if there's no agreement, then we'll go back and hopefully the attorneys with the spouse is successful. But California would be community property in general, unless it's been specifically designated as a separate property, or if it was pre-marriage, capital loss is still carrying forward.
Second question is the incident divorce issue. So you've got a situation where the parties agree and they retain interest in a property. And we talked about that briefly where one of them stays in the house, the other one has moved out. It's been more than 6 years after the divorce judgment. What happens? Is there an issue where at that point they could say this is not incident to divorce once the house is sold after 6 years?
Well, there's no presumption that it is incident to the divorce unless it's within the 6 years and pursuant to a written agreement. Do you have either of those? At least have a written agreement?
Yeah, there would be a written agreement, of course, on that. But
then you don't have a clear answer, I don't think, because you don't know if it's incident to divorce or not. I mean, you don't have that presumption, I should say, working in your favor.
Well, it is rebutted. You do have the ability to rebut the presumption, and there have been instances where that has still been deemed incident to divorce. You just don't have the fallback as the automatic.
Somebody back here.
So I have two questions. One is also a transfer incident to divorce question. Husband files for a petition for dissolution in 2010. A month later, the parties get back together. They buy a house. Then 2 years, fast forward, we're in 2012, they decide to get divorced, that they're going to get divorced again. Husband, this is very odd, files the written response of wife, and by agreement, files it on her behalf. The response also says that the date of separation is back in 2010, but they bought the house in like 2011, for example. So in theory, the petition and the response say that they separated in 2010. They bought the house in 2011, and now they're getting divorced. Can they still use the transfer incident to divorce, even though if you look at the papers, they bought the house when they were both separated from one another, although they hadn't actually finished the divorce. Now, I, of course, said, this is simple. Just amend your petition and response to adequately, to reflect what actually happened. They're like, oh, we're in total agreement. No problem. We don't really want to do that. But I was concerned that there could still be this tax consequence if they get audited, that they wouldn't be able to say that the buyout was a transfer incident to divorce because they bought the house after the papers say they were separated.
Well, practically speaking, there may not be much gain in the house if they haven't owned it that long.
Well, but still, if one's buying the other one out of because they put a lot of money into the house.
Well, when did that happen? When did the buyout happen? That's what we're looking at.
It hasn't happened yet. So they're getting divorced now. They're working on a marital settlement agreement, and the one is going to buy out the other like $150,000.
Okay, so provided that happens within 1 year of the cessation of the marriage, or it happens pursuant to the separation agreement or agreement within 6 years, then it's incident to divorce.
So even though the documents say that they separated a couple years ago, if the divorce hadn't gone through, it still works.
Yeah, because they haven't done anything yet.
Right.
There's no transfer yet.
Okay. And then the second question is, this comes up all the time, where people come in and say, oh, we've been separated for, whatever, a year, 2 years, 3 years. We're finally getting a divorce. We've been filing our taxes, as each is head of household and single, even though they're not divorced. And I hear this all the time. They go, oh, no, my tax person said if we've been separated for X amount of time, we can claim that we are single and not as, married filing separately. Is there any basis in fact to that?
There's some basis, I think, if somebody is a long-term separation, you try to argue that they're not legally married. But if they're legally married under state law still, i.e. require them to file for divorce, then probably have a risk. So then the question becomes, do you do anything about it, or do you just put a paragraph in that says if there is an audit on a prior year, which would be a general paragraph anyway, no settlement agreement, then the spouses will cooperate in providing information to respond to the audit, and if there's a deficiency that comes out of the audit, the spouses agree with respect this way.
Okay, but there is no truth that you can file as a single person if you've been separated for a certain amount of time.
No, not with Alan having started the divorce proceeding, and have at least the interlocutory degree.
Okay.
But again, I wonder if it matters. Is it going to make a difference in tax liability?
Yeah, well, again, from a practical point of view, I wouldn't open up the prior years voluntarily. I would just instead have an agreement between the spouses that they'll cooperate in responding to any inquiries on the prior years. And if there's a deficiency, they'll cooperate in paying back tax and interest.
Sometimes it comes up because people are trying to hide their income, and they don't want the other spouse to see how much they made or what they're claiming and things like that. So
yeah, that actually brings up an interesting point. So we had a situation there recently where it came out in the divorce. One spouse had been working overseas part of the time, a significant amount of income, and not reporting it. So then what do you do as part of your divorce agreement? One spouse would want to, the innocent spouse, if you would want to be indemnified, against the back taxes, liability for that. It could be a very serious amount of a significant amount of income for a number of years. And it could even technically be criminal.
Right, and that innocent spouse relief you were talking about, in practice, I have found that to be a pretty narrow exception. You have to have really good facts to get the IRS to buy it. So there's three parties to every divorce: the husband, the wife, and the IRS. So you might convince two of the three. Another question?
Yeah, a couple of questions. On your section on itemized deductions, it reads as if one spouse chooses to itemize, the other one has to.
If they're married, filing separately.
And if they're filing,
If they're filing jointly, then it's a joint thing. And if they're filing single at a household, then they can do it.
Joint returns I see under alimony, the last item is the spouse do not file a joint return. So if there's a separation early in the year, and then alimony commences later in the year, under some agreement, does that mean that if they decide to file, they look at the tax consequences and say, oh, we save a lot of money if we file jointly this year, that means that any payments that occurred in that year cannot be considered alimony?
Right. They would not be considered alimony from a tax point of view. However, if we allocate the joint liability between the spouses, we can give credit to the one spouse for paying that as a deduction on his or her share of the joint tax liability, and then charge the other spouse with the income on that. So we can take that into account if the spouses want to do it that way.
But then it's not.
But it's not an alimony deduction on the tax return itself if there's no filing jointly.
It's another strategy to consider is if there are interim payments or a kind of some money given and you want to from one spouse to the other spouse to make ends meet for the time being, and then they want to find a way to claim that alimony deduction. They can then, if it's in a somewhat collaborative setting and the spouses are working together, or ex-spouses, they can treat it as a loan. So you increase the amount of alimony right off the bat, write that in as alimony, and then have basically a loan that goes right back and forth, so that the spouse in a higher tax bracket gets the deduction. It's a little tricky, but it needs to be.
Provided you don't straddle years, so you don't run
Right.
against this front-loading rule. And you understand what the issue is. Alimony has to be paid pursuant to a written agreement, right? So the problem is people will make all these payments and document it a year later and try to claim it. That's what we're trying to deal with. We're at the top of the hour, so I'm going to close the webinar. Around some more things to talk about. Stop recording real quick. See where it says stop? Hold on a second.